All right, so we lost our 5-day winning streak on the S&P 500, but we did not lose it in a big way, right? This was a small down day. It was a small loss. It was not that big of a deal. We'll break down the technical ramifications of today's loss, and especially in context of what we talked about last night and what our expectations were for today and the rest of this, at least the middle of this week. It's so far today has played out according to what we expected last night, and we'll talk about kind of what we expect over the next day or two, and how big of a deal it would be if it played out as we expected. So looking at all the technical indicators as well as some past precedent for this type of small decline. We'll break that down. We'll take a look at some really significant moves in other asset classes beyond stock market. Today we saw some pretty dramatic moves that are pretty much a reflection of what's going on with the rate cut odds. The rate cut odds are not the same as they were in September when the Fed came out with their dot plots and the futures market was pricing in cuts galore going into 2025. Things have changed in a pretty dramatic way, and a lot of and the last 2 days have been pretty significant too. So we'll break down those asset class moves and the implications that has on risk appetite in general, including with the S&P 500. We've got some pretty rare correlations going on right now. So we'll talk about those and what's driving this action. A little bit of weakness from a breadth standpoint. We'll talk about the possibility of a Hindenburg-Ullman in today's video as well. And we'll take a look at our trade idea in a sector that we don't want to show weakness that has been. And we'll break down a trade idea there. So let's go ahead and get started. Today is Tuesday, November the 12th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. You'll see posted there, so where we take a look at old Market Outlook trades, see whether we should stay in them or get out of them or not. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here with this thumbs up icon, click on that, it takes you to this page. Scroll down to today's Market Outlook, click on that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms, so thank you to those who do that day in and day out. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we fell almost 18 points here. So our first down day that we had after a 5-day winning streak. As we talked about last night, the near-term line is continuing lower. We expected that would happen. Obviously, we're not getting a big bear market here, so just because we think the market might go down a little bit on a near-term level, this kind of shows you what kind of decline we're expecting. That's what we talked about last night. That's continuing. I still think it will go a little bit further. The momentum line, as we talked about, came out of bearish levels, oversold levels, but not out of bearish, as I expect it will probably turn back down if the near-term line continues into bearish territory. But again, I think something like this, right? This is the kind of pattern I expect will happen. This is the example I showed you last time, and this is kind of something very similar. When your momentum line drops oversold levels and your near-term line is still very high, this is what happens, and I think we're seeing the same thing play out again here. We're still above 2.5% above the moving average, so everything's still fine. When you look at the NASDAQ 100, its intermediate line, again, is crossed above market sentiment. It's rising. It's not above 80 yet like on the S&P, but it's still rising. It's getting close, almost to the 75th percentile. Same kind of bounce on the momentum line, a little bit bigger on the momentum line because we didn't drop as much. And the near-term line is still pretty easily in bullish territory. The S&P is almost below 60. But similar pattern there. The Dow and the Russell is where we get a little bit of difference. The Dow Jones, again, the intermediate line crossed below market sentiment, but you can see the intermediate line did get above the 90th percentile. But look at that engulfing pattern up there at the top. That's, again, it's not the most bearish day. We're slightly above average on the range, so it's not huge. But it's a little bit of a bearish engulfing pattern. The near-term line is out of bullish territory. And the momentum line actually did drop to extreme lows, right, to the 5th percentile, which you typically don't like to see. Now, again, we saw that here, and that wasn't the end-all, be-all But it was the peak, right? We had a few more days to the upside, but then we declined. So again, not something we like to see when the momentum line drops this much down below that red line down there. The near-term line still at the midpoint, so it's not at bearish levels. But again, and everything looks fine otherwise. But even if we don't go down the next couple of days, have we produced something similar where we kind of produced the peak here? A little bit higher actually than where we were above the moving average than we were at those levels. And then finally, your Russell 2000, you can see same thing. The near-term line did fall out of bearish territory. Your intermediate line's above the 90th percentile, just like everything else. The momentum line is deeply oversold, but not extreme. It avoided dropping below the 5th percentile as we did have a little bit of a bounce off the lows. But still, that's a pretty oversold level. Like, this technically is an oversold confirmation signal. It would be better if the near-term line were a little bit lower. It's not, so I wouldn't necessarily say, oh, hey, we're going to bounce off of this, right? I'd be a little hesitant to do that, as I expect, again, something similar to this over here where your intermediate line was very high. You can see the decline we had. Your intermediate line was very high. Your momentum line was at the 7th percentile. Your intermediate line was actually a little bit below the 40th, so a little bit higher or lower than where we are now. But you can see it followed the second day like this. And I can see something like that happening again. We didn't drop below the moving average. We only were bearish briefly, but I can see something similar happening where the near-term line falls, maybe not all the way down like it did here, because, again, we're below the 40th percentile now. But again, like if we're looking for a bearish near-term low to develop on the cross below 60 and you have an oversold momentum line, especially on the Dow Jones, right? Now the Dow Jones, it crossed below 60 pretty easily and you're extremely low. So that suggests that there's a good chance the near-term line does fall all the way down there and would produce a bearish near-term low following a really strongly bullish near-term high. And again, but we're so bullish that bearish near-term low might actually only get you to the moving average rather than through it with with a bull tag. So I think we're okay, right? I think we're okay with another day of weakness, maybe two, before we resume the dark green shading and the green line bullishness that we're seeing. Your S&P 500 is a very strong bullish pattern. Very strong candle up to the upside, up above the average. PPO is in the 91st percentile, so strongly bullish, right? Very mature, but strongly bullish. 3 green arrow charts looking great. The histogram's rolling over, as we said last night it would. The histogram's rolling over. We're a little bit below the average in the range and the volume. We'll come back to it here in just a second. So, and again, that histogram's going to continue to roll over. It doesn't mean that we're going to necessarily roll over, right? Well, there's a good chance we stay above the 17-day moving average because we're so far above it. So your histogram's going to roll over just to get you down to it. And you can see, you typically don't break below the moving average until you actually break, which is what happens when the histogram turns negative, until you're actually now flirting with the 17. So we're so far above it, we're going to, on the way down to it, we're going to get a bearish histogram. And that's the path that we're on right now, and I expect we'll continue that path. Looking at some of these other oscillators, we are rolling back down, but still easily above 30 on the positive indicator. The negative is bounced above 20, so your ADX kind of stalled on its increase. So that's not the greatest for the negative. You'd like to see that negative come down a little bit more, considering how bullish the positive indicator is. When you look at the RSI and the CCI, again, still at bullish levels, so nothing concerning, but not as bullish, right? We never did get to above 70 like we did at the end of that bullish move. Or when we were coming out of the convergence and starting a new leg higher, right? So that's kind of what I was hoping we'd get here to suggest that we'd get a new extended leg higher on this post-election rally. Obviously, we talked about this. It's going to be really hard to get a mature trend simply because we didn't have a reset. So we've ended a mature trend. You typically get a reset, and then you can start a new one. But when you don't get a reset, then it's the next trend. The next bullish trend is going to be weaker, and that's kind of what we're seeing. It's not going to be mature, most likely. Nothing's 100% or 0% in technical analysis. But the odds of a new mature trend coming out of this obviously are a lot lower. So that's what that's looking like. And then we look at the Bollinger Bands and the Keltner channels. We are now no longer above the upper band. We are still in the upper quartile. The bandwidth is still rising. We're still above the upper Keltner channel with the momentum still rising. So everything is fine. But remember how when we get so extreme above the upper band, when you break that band back down, that typically suggests the peak is in, right? So it doesn't mean that we have to drop. Like we didn't drop here. Eventually we did, but we didn't drop initially at least. But and over here we didn't go up that much. But the peak, we actually went up a little bit before the drop, but it suggests that the peak is in. And we'll kind of watch to see. Usually the reversal comes, the actual decline would come when we would break that Keltner channel and stay below it. Here we kind of broke it, but we were staying above it for most of that time. Once we broke below it and stayed below it, then the reversal came. So the first stage of this kind of extreme breakout move occurred. The first stage of the peak has occurred with breaking the Bollinger Bands, and we'll watch over the next day or two to see if we break below that upper Keltner channel as well. If we take a look at the intraday chart, you can see lower high and a lower low, but we did close at yesterday's lows. We did not get below it, so that's a good sign. Not so bad there. Obviously, a big vacuum here to fill in, unfortunately, but that doesn't, again, that doesn't mean that we have to have an intermediate decline. It just means, there's a very good chance for an intermediate pullback, right? We are below yesterday's low on the Russell and below last week's high on the Russell. So, and we're flirting with that point of control. And again, like I said, that big vacuum here that could bring us, more volatility over the next day or two, maybe than some people want. Not bear market volatility, not even really intermediate pullback volatility. But right now, most people don't want the market to go down at all on any day. And so you're going to get a down day or two because that vacuum is going to be sucking the price action towards it there. If you take a look at, as I mentioned, we had below average range and volume, but that's okay too, right? As long as we're below 1% on the normalized ATR, that's pretty bullish. So that's what we want to see. We don't want to see big down days. We don't want to see big down days. Small down days, perfect. Big down days is not what we want to see. So that's okay. Volume is already pretty low, so it can't really be that much lower. And then the volatility is also pretty low too, like below 15, great. Below 90%, great. The VVIX below 90, barely, but at least it's below 90. That's great. And the actual VIX itself remains below the 200-day moving average. Now, we're not extending below, so that's, a little concern. And we got to this point with a pretty, big drop in momentum there. But, we're kind of, at least we're below, right? And that's a good sign. And we would like to extend below to continue the current bullish trend that we're on right now. All right, now let's take a look at what's driving the price action today. And today there's a big move higher in bonds and the dollar. If you take a look here, let's go out to November to just look at today alone. So November the 12th. Look at that big move higher. Is that the second straight day? I think that's the second straight day that we've had a big move higher in the dollar. Small caps were okay yesterday. They were not okay today, as you see. And gold has really been suffering from that strength in the dollar. Emerging markets are getting hammered 2 days in a row because of the strength in the dollar. And you can see yields have taken off for 2 days in a row, and putting pressure on commodities as well. Commodities have fallen 2 days in a row as well. Large cap stocks haven't really moved today. S&P, you can see, is down only 1/3%, of course, as I showed you before. But still, that's a big move higher, and you can see that here in the charts. Let's take a look. Well, let's pull up the dollar here on this chart. Look at that rally. This is one of your bigger moves that we've seen in the dollar over a 5-day period. Again, the MACD is high. The histogram is high. We've already had the surge, right? The post-bearish move surge. So we're not going to probably get a MACD higher than this, nor are we going to get a histogram as big as this. So which makes this move even. The fact that we're getting such a strong 5-day rally, when you look at the rate of change here. Oops, sorry, not that one. 5-day rate of change here. When you look at the 5-day rate of change and how big this move has been, and again we'll go to the dollar. There we go. So 5-day rate of change, about 2.5% almost. Is huge return. But again, it's not coming off of. See, the last time we had a pretty big return, in 5 days that was not coming off of a bearish move, right? Because it was kind of like this, right? Where, here, let me pull this up on this chart, and we'll pull up that MACD. So the last time we had that kind of a move, which again, like we had the surge, the histogram actually did, and the MACD actually did get higher than that. But again, it wasn't very much of a surge as a result, but that ended up being the peak, right? Over here, the MACD got a little bit higher on this 5-day or however many day rally we had. MACD got a little bit higher, but obviously the histogram didn't, because there was our surge. And so here we go. Like, we definitely had a big surge, bigger than all these. The MACD got bigger than all of these, and now here we are in that secondary, that kind of secondary move, right? Like this was a secondary move, and this was a secondary move. Well, this is even a bigger secondary move because it's one of the bigger 5-day moves that we've seen in quite some time, right? You have to go back a little bit, to 2022 to see a 5-day move that's bigger than what we just saw, and that was during a rate hike cycle. So big rally, but most likely not going to. And if you take a look at the correlation right now, which is interesting because usually there's a negative correlation between the dollar and stocks. So look at that. I mean, there's an 80% positive correlation right now between the dollar and equities over the last 2 weeks. That's a tremendous positive correlation. Again, that's atypical. Obviously we oscillate, but it's atypical. The last time we had that went into a bearish move for equities and a bearish move ultimately for the dollar. And you can see some of these others. There was a move where they both went down there. Here we had another move where they both went up. They were both positively correlated, and then ultimately led into that decline. And this one led into that decline on the S&P. And this one led into a convergence on the S&P where they were both rallying. So it's not necessarily the best scenario to have them both rallying up to the upside, especially, like I said, to the degree that we've had them rally this particular go-around. And then I mentioned the other big move we had today was yields. But keep in mind that we're at 4.43%. If the Fed cuts in December, that puts us at 4.375%. So that's not very far away from where we're at right now on the 10-year yield already. So we're pretty capped. In fact, when you look at the spread is close to zero. And that's probably, we're going to probably get to zero as the 3-month falls down to 4.375 and prices in this December cut. I think we'll ultimately get to that December cut. This will, it's been dropping. It's down to 58% from 84 a month ago, from 77 a week ago. But it's probably going to get back up to 100, I would expect. But then you can see the cuts for January are way off the table now, 17%. Like, the cuts for 2025 are done. Remember how the Fed at their last meeting had changed their projections and priced in 200 to 225 basis points of cuts for between then and 2025? Well, we're going to get to 100 by the end of the year, which is what they projected. And then it doesn't look like they're going to cut, at least in the first half of the year at all next year. So it'll be very interesting to see what the December dot plot will look like at the next meeting, which will have 2 CPI reports, as well as the December or the November jobs report throughout that first week in December as well. So we have a lot on the plate as the yield spreads today are rising up to what I think will be their peak. I think that this spread is already peaked because the 2 years already where it needs to be for the Fed to cut that last time. But this spread, I think, has got a little bit more left to peak. Close to zero. I think it's going to peak at zero. And then I think they're going to roll over. And I think that ultimately causes some kind of volatility into the end of the year. But then I think it rolls over and we get that bullish first half of next year. So that's it. Those are the 2 big drivers. Such big moves on the dollar. And then, as I mentioned, the other kind of factor that's interesting here is that commodities have been so bearish. Falling back. Holding yesterday's big drop, falling back below the 50-day moving average, falling below the point of control over the past year. This is a significant level to get below 22, and for crude oil, which is the biggest component of that, so close to its 52-week lows after 2 big down days there. This is not something you typically see in strong bullish markets, right? You typically like to see, a strong correlation between equities and and commodities, and that has not been the case. In fact, there's a negative correlation right now. So something's got to give. Either commodities are going to really ramp up and catch up to where the S&P is, which would be a reflection of increasing inflation expectations, and that will be, which is what we're seeing in the 10-year yield. So you'll see, you'll either get that, which wouldn't be a bad thing if that was the catch-up trade, but it would create some volatility, or you're going to get that volatility even sooner with the S&P catching down to where commodity says it should be, right? So like we're nowhere near, like we peaked right here in commodities, and we kind of flirted, but we were obviously a lot higher on the S&P than commodities were in July, but we're way, like the S&P is even further higher than that, and we're way down. So we are really divergent between commodities and the S&P. So what is commodities telling us that the S&P doesn't want to believe right now, right? One of those commodity relationships that we like to really closely look at is the relationship of copper to gold to see if there's some risk appetite. This is typically a relationship that's positively correlated, typically with risk appetite. Obviously below the 200-day moving average. It's up today, but you can see, it's having a hard time getting back above these moving averages here. So there's that relationship kind of telling us that maybe there's not a whole lot of demand for the type of commodities that are more associated with economic expansion versus safety, right? Which is gold to be more a reflection of safety, whereas silver and copper are more a reflection of precious metals that are more associated with economic expansion, right? With growth and economic activity and construction and manufacturing activity there. The McClellan oscillator dipped back to negative levels today. That's significant because you have a increase in the number of new lows right now. Right now it says 48, but if you look at the actual number here from the Wall Street Journal's page, you're at 62. Remember the magic number is 72, and we're clearly above 72 on the new highs because we're at 184, though that's down from that exhaustion type peak we got yesterday, well above 400. So if we get up above 72 on the new lows with a negative oscillator, that would be one Hindenburg-Ullmann. Remember, single Hindenburg-Ullmanns are not necessarily bad. We had 5 in a row in September. This would be another one that's past that 30-day window, so we can't clump it with the ones in September. But it would be something to keep an eye on heading into the rest of this week, right? Are we going to get any more of these type signals if that new lows index continues to be as high as it is? The number of stocks above the 50-day moving average is back down, right? Again, it's above 300, so great, and it's around the moving average, so nothing's too bad there. Here you can see we are moving back below that 200, the 20-day average of the number of stocks above their 200-day, and that's not a good sign of breadth. So the breadth is not, had been looking like it was pretty decent, but is not actually as good as it seems, right? We had a good day yesterday with the Russell, but it seems like it's more of a blowout type move than it has been like a trending type move. Like we're going to get that kind of relationship now every day where the Russell outperforms and we have this kind of broadening trade. That's a myth, this idea of a broadening trade. Usually it broadens out right before it peaks, right? And that may be something that we're seeing here. As I mentioned to you, I believe I mentioned to you in the video last night, the retail traders really, like that's the biggest level we've seen in the gamma exposure that we've had, which is a reflection of retail trader demand. That's the biggest number we've seen in quite some time. So a little bit, we've seen multiple exhaustion type moves and indicators in the past couple of days here. And if I were to take a look at the sector moves today, you can see the big move in discretionary since the election. But if I look at today alone, let's go out to 5 minutes. Then you can see, good, we have the sector we have leading is the one that we want leading. So yes, we have this discretionaries down a little bit. It was such a big winner. And some of your other cyclical areas are down. Industrials and materials, financials and energy, they're all kind of either down or lagging or both. The S&P 500. Staples is really outperforming that. Again, that's a relationship that's had a little bit of a reversal pattern here today. Sorry, the wrong button here. Give it a second. All right, so let's check this out here. So a little bit of a reversal pattern. Sorry, I'm frozen. There we go. So let's look at XLY, which has been very bullish relative to XLP, right? To the point where it's kind of parabolic in its move. Look how parabolic XLY performed relative to XLP. Already had been pretty bullish and then just went crazy here. Look at that PPO. I mean, let's get some context on just how crazy that move was on discretionary relative to staples. Look at that there. Big move up in the PPO. We've seen this before. Big move up on the RSI. We've seen this before as well. And then you look at like the DMI up to 45. We have not seen it that far for that long, right? It kind of got up that high there, but not to this extent. And then look at that CCI. So extreme move up here. And you're going to get moves like today, and we'll see. You know, a drop in this, considering it's highly correlated with the S&P, would most likely be associated with, you know, some kind of at least near-term decline, as I mentioned yesterday. At least some kind of where the near-term line, it might not be an intermediate pullback, but at least the near-term line itself pulls back into bearish territory. All right, well, that brings us to our trade idea of the day. I want to take a look at Micron in that technology sector, which actually, remember, the technology sector has been doing pretty well today, but this part of that sector hasn't been. The chip sector, Micron's down 4%, producing a bull tag. A little bit of a different bull tag than what we saw just a couple weeks ago. Over here, you can see the near-term line did not cross below the intermediate line. It was already below it. The intermediate line was falling like it was now, but at least it was falling from what was a relatively bullish near intermediate peak. This peak is not a bullish intermediate peak. And we have a near-term line crossing below from a strongly bullish level here to pretty bearish. Not as bearish as it could be. Normally, I'd actually be pretty bullish on this, but considering that crossover and how big and how fast the move has been in the last couple of days, that's a little bit concerning for me there. Obviously, when you look at the weekly chart, there's not, we're not going to get like bearish breakout signals on this. You can see it's another transition candle. You can see the candle's a little bit more bearish though this go around than some of the last ones that we've seen. And we've got the red arrow again. As you can see, the PPO is flat. We try to get a golden cross. We're really not building on that golden cross at all. Here's the other thing that stands out to me about the current bull tag, which remember is basically a 3 red arrow signal. The last 3 red arrow signal we did not get above average volume. This one we are, right? The average is a lot lower, but we're above that average. And again, we still have about 10 minutes to go. Again, I actually put on the trade, the Market Outlook trade already in the Market Outlook live videos. I record this afterwards. But that's another reason why I'm not as thrilled with that 3 green arrow signal. If you look at these other oscillators, you'll see that they're not necessarily bearish, but they've stopped being bullish, right? Look at that. I mean, we have a bearish crossover here with both lines still above 30, or at least close to 30, which is kind of rare for them to be both that high. That's why your ADX is so low, but that's a pretty high level for both of them there, which means the stock is pretty volatile. It's not going to be a kind of a sideways mover. Your RSI and CCI have dropped below their midpoint, so they're out of bullish territory now, and not bearish, but they're definitely not bullish anymore. You look at your Ichimoku cloud. This is the other thing that stands out over here. This last bull tag basically ended a bullish run that we had that was not very mature. It was an intermediate strength trend. Never did get to mature levels like this one. But this bull tag is actually starting a bearish trend. A weak one. It's weak, but it's a bearish trend there. And then finally, if you look at your Bollinger Bands and your Keltner channels, you can see we are in the lower half of the bandwidth like we were before. We're in the lower half of the bandwidth, and you can see the bands. This go around, now we had red dots there. Now we have green dots, so the bands are flirting with breaking outside of, which means that we're poised for a volatile move to develop here. So what I decided to do was to come to the low 20 deltas and sell that strike, so sell the 92.5 there, and then buy the 95 for protection. All right. So keep my risk the same. And you notice at the low 20 delta, typically I'm getting about a 3-to-1 or maybe a little bit more, maybe up to 4-to-1 reward to risk ratio with very little flexibility. But I've got a lot of flexibility for timing, and I only have about a 2.5-to-1 reward to risk ratio here. So that kind of tells me even the options market is leaning more to the downside because they're not paying out as much for a similar probability of success based off of that delta there. And that's our trade for today. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up in a new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody. We'll see you all tomorrow.